some of the economic data to start off here. We saw China overnight lower their interest rates, but this is the kicker. They didn't lower it as much as the market expected. So again, rate cuts generally are viewed as a positive for the markets. In China, they lowered rate in terms of rate cuts. They lowered, but it was less than expected. So if we jump over here, this is the Hang Seng chart, right? So this is the Hong Kong stock market, which is the one I follow. And we can see that even with that rate cut, all right, even with the rate cut, it still caused the Chinese market or the Hang Seng to fall additionally. We saw a loss of 1.82%. So China continues to be in free fall.
Growing concerns have arisen over the potential default of property giant Country Garden's debt, echoing the apprehensions triggered by Evergrande's massive default in 2021. These worries extend to fears of financial contagion within China's economic system. In parallel, China's decision to discontinue detailed reporting on youth unemployment figures has fueled further uncertainty. This move follows a sharp increase in the jobless rate to 21.3% in June. Shifting focus to the U.S., the Federal Reserve's recently released minutes from its July policy meeting reveal a division among officials. While most see notable inflation risks that might necessitate increased tightening, some advocate for maintaining current interest rates. The impending Jackson Hole Symposium, featuring Fed Chair Jerome Powell's speech, is poised to influence economic indicators and potentially impact both conventional and cryptocurrency markets.
Very important this week because Jackson Hole is this week. Jackson Hole is the meeting in Wyoming of the Federal Reserve board members, basically. And what we can see here, and I have to bring this off here, let's bring that up. So here is your 10-year yield. Now, what I'm watching really closely on the 10-year is this high from October. And if we drag this out, you basically kissed it on Thursday, right here. You pulled back, and now you're pushing back up. If the 10-year yield breaks above 4.33%, the markets really should start to sell. Remember, when you were over here, okay, when we were over here, this is where the markets were selling off into October. They bottomed in October when the yield topped out. So the thought process is we have come off of our highs in the S&P, but the concept would be is that if you're going to break above here, at some point that pressure on yields is going to make money start to flee stocks. All right, we've had this big chase for returns. Bonds, honestly, as crazy as it is, bonds are very disliked right now, even though they're paying such a high level, because people, again, are looking at stocks and saying, wow, I got to be in the stock market. You know, this is where the big money's being made. I think that changes. I think that as yields go up, smart money, which, again, generally is institutional money or billionaires, they're going to start to say, hey, listen, the 10 years now paying X amount. I'm going to take some of that money out of the risk of a policy failure by the Federal Reserve, which could cause a recession and a market collapse, and move it into the bond market. So again, watch this level 4.33. Look for the S&P to start selling off if we get through that level. Okay, next up, I want to go to a couple of the charts here. I want to quickly look at the dollar. The dollar is into technical resistance here. Take a look at this chart right here. I'm going to zoom in a little bit. This is a big level on the dollar. Okay, you have a very clear pivot point here, right? Trend line, a level here, and a level here. All right, so we're right up against resistance on the US dollar. Now, the best thing for markets in the near term is the dollar to pull back. That should help asset prices. All right, if it doesn't, and you break above, short term, that could be a negative. It could also insinuate that we're seeing people flee foreign markets like Japan, which we know the yield curve control issues there, the dollar yen. China is a mess, obviously. Europe's not doing so great. It would tell us that, again, if we break up, that the U.S. is really still the game in town in terms of the dollar. So watch for that. We're right at a pivotal level. Now, I want to point something out. The yield is at a pivotal level. The dollar is at a pivotal level. All right, these are major things. In fact, gold's at a pivotal level too. Think about what we're coming into this week. Jackson Hole on Friday at 10:05 a.m. Eastern Time, a Jerome Powell major speech. Now, this speech is important because it's going to guide the markets whether Jerome Powell is going to hike in the next couple meetings or he's going to be on the sidelines. And that's why this speech is so important because, remember, we got the minutes last week. They were very, very hawkish. So he's going to get a chance to guide us to what the rates will do. That will affect the dollar. That'll affect yields. That'll affect gold, silver. the stock market, maybe even crypto a little bit. So keep that on your radar. Bitcoin, again, guys, is very simple here. So Bitcoin, again, has broken the level I said it was likely going to break. We talked about this. You guys, it's been no surprise that when we were at 31,000, I was skeptical we were going to break out, unlike pretty much everyone else out there. But now we've fallen back down. Now the question is, here's your next support level, right? So looking at supports, we have a very clear $25,000 support, very clear 20,000 support, and if we break that, eventually you go back to the lows. The only way, and I've said this now, and this has become my thesis, is the only way Bitcoin breaks 15,700-ish, the lows, is if we see the stock market go back to the October 2022 lows or lower. Then I actually think it can. Otherwise, I think Bitcoin probably holds up relatively well. My big concern, though, is that I actually do believe the stock market is going lower significantly, as I think this narrative that it's going to be a perfect landing and everything is going to be great and we're going to all sing kumbaya, I just don't buy it. Again, history shows us that when the yield curve uninverts is when we get the recession. We haven't uninverted yet. So there's still a lot of things. We also know that there's a delay in interest rate policy of 6 to 12 months. So we're only, based on what the market's reacting to, we're at like 2.5% on the Fed funds rate versus 5.25 to 5.5.
The US dollar reversed its upward trajectory, dropping from a 2-month high on Monday after recording 5 weeks of consecutive gains. This shift was attributed to an improved risk sentiment in Europe and the focus turning towards the Federal Reserve's upcoming Jackson Hole Symposium, set to start on Friday. While the dollar index slipped by 0.2% to 103.18, it remained near its recent high of 103.68. The dollar's weakening is being influenced by a more stable risk appetite, reflected in rising European shares and positive signals from Wall Street futures. All eyes are on Fed Chair Jerome Powell's speech during the Jackson Hole event, with expectations that his comments might steer the course of U.S. Treasury yields. These yields have been instrumental in bolstering the dollar's recent gains, pushing 10-year yields to a 10-month high of 4.328%. This year's theme for the symposium revolves around structural shifts in the global economy. Experts suggest a potential shift away from decades of ultra-low rates tied to minimal inflation, with policymakers possibly leaning towards maintaining higher interest rates. Meanwhile, the Australian and New Zealand dollars remained close to their recent lows of 9 months. China's unexpected move to lower its 1-year benchmark lending rate, while keeping the 5-year rate unchanged, led to disappointment in the markets. This decision aimed to stimulate credit demand amid concerns over the economy's slowdown. Yet, the persistently weak yuan constrains China's ability to engage in extensive monetary easing due to fears of capital flight and yuan depreciation. The People's Bank of China's commitment to maintaining liquidity and precise policy implementation in support of economic recovery, despite challenges, was underscored by its recent reduction of the medium-term policy rate. The unexpected stability in the 5-year lending rate surprised analysts, who anticipated more significant cuts given the property sector's troubles and growing default risks among developers. As the Jackson Hole Symposium approaches, speculation lingers on potential outcomes, particularly in terms of further rate hikes. Feel free to share your thoughts on this matter in the comments section below. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.